Trading the wrong pairs at the wrong time can seriously hurt your results. For example, did you know that trading euro-dollar in the Asian session is like fishing in a dry pond? But during London, it's a whole different game. Or that if you're trading gold the same way in every session, you're already behind? And here's a classic mistake: buying pound yen while selling euro yen during the Asian session. One of those trades is almost guaranteed to hit stop loss while the other wins. So let me show you why timing is very important and how to avoid these common mistakes. So here is what you'll learn in this video: how the major trading sessions drive the Forex market volatility and liquidity, which Forex pairs are best to trade in each session, why pair correlations can make or break your trades. Also, stay tuned until the end of this video, where we'll break down how gold moves at different times of the day and reveal the best trading setup that has made us the most money. If you're interested in learning advanced trading concepts, hit the like button to support us and subscribe if you're new. On each trading day, 3 major markets around the world define our trading sessions: the Asian, London, and New York sessions. This chart shows the opening and closing times of each session in GMT. As you can see, some sessions overlap at specific times, creating high-volume trading hours. If you want an easier way to mark them on your chart, go to the Indicators tab on the TradingView platform and search for market sessions. Click on the indicator created by Leviathan, and this will automatically mark the sessions on your chart. To customize the settings, double-click on the indicator name. Here, you can change colors or uncheck any session you don't want to display. Now, why are these sessions so important? Understanding the characteristics of each session can significantly impact your trading results. The key differences between these sessions are trading volume, actively traded currencies, and price action. Starting with the trading volume, the Asian session tends to have lower trading volume because major financial centers like London and New York are closed. The market often consolidates during this time, with price moving sideways or in small, narrow ranges. You'll notice smaller candlesticks with lower wicks, indicating less price movement and fewer breakouts. This period is generally more quiet as traders in the region finish their workday, and the market is waiting for the London session to open. However, JPY, AUD, and NZD pairs may see some movement due to Asian market activity, but overall, price swings remain limited. The London trading session, on the other hand, is known for its high volatility and liquidity, making up around 40% of the daily Forex trading volume. When London opens, the market typically experiences strong price movements and trending behavior, which are signs of high volatility. It's common to see breakouts from the Asian session range, creating new highs and lows. This session often sets the direction for the rest of the trading day, making it crucial for traders looking to capture significant price moves. The New York session is characterized by high liquidity and market volatility, especially during the overlap with the London session. During this time, you'll often see sharp price movements caused by economic reports. These reports can cause big changes in price, especially in pairs that involve the US dollar. Price movements are usually more exciting, with breakouts and reversals in this session. The volume creates more unstable price action, sometimes even sharp spikes and long wicks. The New York session overlaps with London, making this the most active period of the day, often resulting in very large candles. The second key difference between the sessions is the actively traded currencies. When discussing the Asian session, you'll notice that the Japanese yen, Australian dollar, and New Zealand dollar are the most actively traded currencies. Compared to these, trading activity in other currencies is quite limited. As a result, price movements in currency pairs during the session are largely influenced by these 3 currencies. For example, if you watch the USD-JPY chart during the Asian session, you'll see that the value of the Japanese yen primarily influences its price movements. This is because the Tokyo market is open, leading to higher trading volume in JPY pairs as banks, institutions, and traders in Japan actively participate in the market. In other words, It's the value of the Japanese yen that drives the price movements of USD/JPY during this session. In the London session, on the other hand, pound, euro, and Swiss franc are the most actively traded currencies. This means that the price movements of pairs involving these currencies are primarily influenced by their values, as the London market is highly active during this session. An important factor to consider is that currencies go through periods of strength and weakness. For example, if you want to trade euro-pound during the London session, you need to ensure that one currency is weak and the other is strong. This is the only way euro-pound will experience significant movement. However, if both currencies are strong, the market is more likely to consolidate, making it difficult to trade effectively. So, it's best to trade a currency pair where one currency is actively traded while the other is closed. For example, trading euro-yen during the London session works well because the euro is heavily traded, while the yen is less active compared to other currencies. So the euro-yen price movements are influenced primarily by the euro, resulting in large price trends and movements that we want to see during the London session. Finally, in the New York session, the US dollar, Canadian dollar, pound, euro, and Swiss franc are the most actively traded currencies. Since the USD is involved in the majority of Forex transactions, this session sees significant liquidity and volatility, especially in USD pairs. Additionally, the overlap between the London and New York sessions creates some of the most active trading hours of the day, leading to increased price movements and strong trends. A crucial factor to consider in the New York session is the impact of economic news releases. Major U.S. reports, such as the inflation data, interest rate decisions, GDP reports, and Federal Reserve statements, are often released during or just before the session opens. These news events can cause sudden spikes in volatility, driving the market up or down regardless of technical analysis. This is why it's essential to check the economic calendar before trading in the New York session. To access an accurate economic calendar, go to the fastbull.com website. From the Products section, click on Economic Calendar. Here, choose your time zone to view a schedule of upcoming economic events. The 3-starred news items highlight high-impact events that can influence price movements. A major news release can override technical setups, leading to unexpected breakouts, fake-outs, or sharp reversals. Another important factor to consider when trading Forex is the correlation between currency pairs. Correlation refers to how two currency pairs move in relation to each other. Some pairs tend to move in the same direction, while others move in opposite directions. When you analyze euro-yen and pound-yen during the Asian session, you'll notice they tend to move in the same direction. This happens because the yen is the only currency actively traded in these pairs during this time, meaning their price movements are primarily driven by the yen's strength or weakness. However, if you look at Aussie yen, you'll see that its movement isn't as predictable as the other three. That's because both the Australian dollar and the yen are actively traded during the Asian session. This creates a kind of battle between the two currencies, leading to less clear price movement. Here's an important takeaway. When selecting trades, it's best to choose pairs where one currency is the dominant factor in that session. Pairs like pound-yen, euro-yen, and dollar-yen in the Asian session are ideal because they're influenced by just one actively traded currency, the yen. This gives you a clearer picture of price movement and better trade opportunities. Now let's move on to the third key difference between the sessions, which is the price action. But before we continue, if you're an experienced trader and need more capital, Funded Next is an excellent option. They're one of the top-rated prop firms on Trustpilot and offer some of the most unique services in the industry, including a 15% profit share from the challenge phase, the lowest package priced at $32, and many more. Plus, they provide flexible funding options to support your trading needs. Check out the link below to stay updated on the latest offers and special deals. In the Forex market, time and price are connected, with volume affecting price movement throughout the day. When you look at major currency pairs, you'll notice some common patterns at different times, which can give you good opportunities. The Asian session is often about consolidation and forming key levels. Because the volume is low, the market tends to stay within a small range, and price action during this time helps set up for bigger moves later. The London session is known for breakouts and continuation. As more participants enter the market and volume increases, the price usually moves strongly in one direction, breaking out of the range from the Asian session. This is when you can follow the trend and make profits. The New York session is known for reversals. When New York opens, many people take profits or change positions, which can cause the price to move in the opposite direction of the London session. This creates new opportunities for you to make trades in the opposite direction. These patterns happen often enough to help you build a strategy, so you can predict price movements based on how each session works. So far, we've explored how currency pairs behave during major trading sessions. But what about gold? If you observe gold's price action on the chart, you'll notice that it is actively traded across all sessions. This means there's consistently good trading volume, allowing us to catch opportunities throughout the day. However, gold is well known for its deep retracements, often shaking out weak hands before continuing its trend. So, what's the best way to trade it? One of the most effective strategies for trading gold is trend-following setups using Fibonacci retracements to pinpoint ideal entry points. To identify these entry points, we use 61.8% and 78.6% Fibonacci retracement levels. In an uptrend, look for buying opportunities when gold retraces to these levels and starts showing signs of reversing. In a downtrend, consider shorting when the price retraces to these levels before continuing its downward movement. These Fibonacci levels often provide strong entry points with a high risk-to-reward ratio and allow us to place a safe stop-loss and benefit from trending markets. Now let me show you how to use this trend continuation setup correctly with a real chart example. To set up your chart for trading gold, start by removing all indicators and drawings, leaving only the naked candlesticks. Set the chart to the daily time frame to begin analyzing the price action on a higher time frame. In this time frame, the main thing we need to focus on is marking the key daily levels in front of the price. Pay special attention to the levels that are near the current price. Look for areas that have experienced multiple rejections, sharp moves away from the level, or recent respect by the market. For example, at the top of the chart, here we have a strong resistance area where the price has rejected multiple times. Additionally, this double bottom can act as a potential support area if the price returns to it, so we mark it in. When marking key levels, identify a price level that captures the most touches. It doesn't matter whether you draw from the candle bodies or the wicks. The reason we focus on higher time frame key levels is that we don't want to trade blindly on lower time frames. A small reaction to these levels on the higher time frame can result in a significant trend change on the lower time frames. Now let's zoom into the 4-hour chart to refine our analysis. On the 4-hour chart, the first step is to adjust the daily levels to ensure they align with the most touches and recent price reactions. Next, identify and mark key 4-hour levels using a different color if they are visible. For example, here, we have a major market structure level that has acted as both support and resistance multiple times. Additionally, there's another important level nearby. Notice how many times the market has reacted to this price level. We use a different color for these 4-hour levels to distinguish them from the daily zones, making it easier to differentiate between higher and lower timeframe key levels when zooming in. However, all of these zones remain potential reaction areas when the market taps into them again. With that in mind, the price has recently broken above this level, indicating that demand is in control and the market could push higher toward the next key level. This move would establish a trend on lower time frames, potentially presenting us with a long trade opportunity. Now let's zoom into the 15-minute chart, which will serve as our entry time frame for this gold trading strategy. On the 15-minute chart, we can see a clear uptrend. The price has recently broken above the 4-hour key level, and we expect it to push higher toward the next level. Now, how do we enter the market? We use the 78.6% retracement level to find an entry. First, we identify the start and end of the recent impulsive move and apply the retracement tool. A buy limit order is placed with a spread size above the 78.6% level. while the stop loss is set below the swing low to give the price some breathing room. Our first target is the close of these candles, as we expect the price to test this level, even if a reversal is coming. The long-term target is the next 4-hour key level, where we anticipate a reaction from traders. Now let's see how the market plays out. The price has mitigated and broken above the 4-hour level, which suggests that demand is in control and we could see further upside movement. However, to confirm this breakout, we need to check the 4-hour chart. A breakout is only valid if a 4-hour candlestick breaks and closes above the key level. When we check the 4-hour chart, we see that a candlestick has indeed closed above the level, confirming the breakout. Now that we have confirmation, we go back to the 15-minute chart and look for another long entry. Once again, we apply the Fibonacci retracement tool and place a buy limit at the 78.6% retracement level. But this time, we ended up losing the trade. The reason? It was a failed breakout, and the price reversed from the 4-hour key level instead of continuing higher. This is a great example of why higher timeframe key levels should be treated as zones rather than solid lines. A small reaction at these levels can sometimes result in a complete reversal. But remember, not every losing trade means there was something wrong with your trading setup or execution. Losses are part of trading, and expecting a strategy to work every single time is unrealistic. As traders, we are making educated predictions about future price movements, but the future is inherently unpredictable. The key is to stick to a solid strategy, manage risk properly, and accept that losses are part of the game. So guys, I hope you found this video helpful. If you did, please smash the like button to support us in creating more content like this. And don't forget to leave your thoughts and questions in the comments. See you in the next episode.